For some time now, what has been debated is clearly revealing itself. We are approaching the end of the global order established after World War II. This does not mean that trade will end. It does not mean that capitalism will collapse. The only thing changing is the power architecture behind the system. After 1945, the world powers agreed on a new balance. The United States provided security. The dollar became the reserve currency. Energy was priced in dollars. Europe focused more on prosperity than production, and expanded its welfare state. Japan kept the system liquid with low interest rates. China, over time, became the world's factory. Production shifted to Asia, while consumption concentrated in the West. Capital moved freely. This model worked for decades. It generated growth. It expanded asset prices. The middle classes grew wealthier. Financial markets deepened. But the same system also brought vulnerabilities. The United States outsourced production. Supply chains spread across the globe. Cheap labor became the priority. Profit margins increased, but industrial infrastructure weakened. The middle class shrank. Wealth concentrated in a narrower segment. The system was functioning, but it was not balanced. At the core of this order was the petrodollar. Energy had to be purchased in dollars. Anyone who needed energy needed dollars. This continuously created supply and demand for the dollar. As long as demand remained strong, the United States could run deficits, borrow, print money, and still keep the system standing. Military power was the guarantee behind this order. Financial institutions and central banks ensured the flow of money. States that followed the rules gained access to capital. Those that did not faced harsh sanctions and sometimes even harsher consequences. But today this picture is changing. Some countries have begun building alternative mechanisms. Trade in local currencies is increasing. Gold reserves are rising. Regional payment systems are being established. Energy agreements are diversifying. This does not mean the system will collapse overnight. However, the single-centered structure is eroding. Even the language used in meetings, such as the World Economic Forum, has shifted. The word abundance is being replaced more frequently with resilience. Resilience means backup capacity. Backup capacity means higher costs. Higher costs mean lower growth. The era of optimizing global supply chains is giving way to a period of strategic duplication. In this transformation, four main power clusters stand out. The first is the financial-industrial complex. Global asset managers control trillions of dollars. This money does not belong to them, it belongs to investors. Yet the voting rights are in their hands. Index funds finance companies automatically. Since most investors do not exercise their voting rights, decision-making power remains with the managers. Because access to capital is essential for companies, those who manage capital indirectly shape corporate behavior. For this structure, the most critical element is the fast and frictionless movement of capital. Borders, differing regulations, and multiple currencies slow this flow. Digitalization and tokenization are presented as solutions. The representation of assets on blockchain networks, 24/7 global trading capability, and fractional ownership are being emphasized. But this also significantly increases the power of whoever controls the infrastructure. There is a second actor within the financial system: banks and central banks. Their primary concern is not losing their role in money creation and intermediation. If private digital currencies and alternative payment systems become widespread, banks' deposit bases could shrink. For this reason, central bank digital currencies are becoming a major topic. Yet digital money also brings debates about surveillance and control. The crypto ecosystem, on the other hand, demands a more competitive structure, higher returns, more open access, fewer intermediaries. However, regulations are often designed in ways that protect the existing banking system. This struggle is technological as much as it is political. The third power cluster consists of sovereign states. For them, the main priority is not global efficiency, but control. Energy, food, industry, and defense capacity are considered strategic. Some countries are choosing sovereignty even at the cost of slower growth. Instead of full integration into global capital, they are adopting selective cooperation models. The fourth layer is the military-industrial structure. This system does not thrive on instability, but in periods of uncertainty, budgets tend to rise. When the balance of power is recalibrated, deterrence becomes critical. Even if the probability of open war remains low, defense investments may increase. The objectives of these actors are not identical. Financial structures seek fluidity. Banks seek to defend their position. The crypto world seeks competition. Sovereign states seek control. Technology companies seek data and contracts. The military structure represents enforcement power. The unraveling of globalization means friction for finance. Yet digital tools may reduce that friction. While physical goods slow down, financial assets may accelerate. In this way, power can partially detach from production. However, the main risk is economic. If growth slows, rolling over debt becomes harder. Global debt levels are historically high. If interest rates remain permanently elevated, fiscal pressures will intensify. This may not signal a sudden collapse, but it does imply prolonged tension. The world is likely to fragment into parallel blocks rather than converge into a single new system. Regional financial networks, alternative payment systems, selective alliances. The dollar may not disappear, but its marginal dominance could weaken. Small percentage shifts over time create large structural consequences. This process is not a battle between good and evil. It is a redistribution of power. Political tensions visible to the public may be part of the broader picture, but capital decisions are often made quietly. Reserve reallocations do not make headlines. Supply chain adjustments unfold gradually, yet their consequences are lasting. Historically, monetary orders change every few generations. The gold standard. Bretton Woods, the petrodollar system. Now, we may be entering a digital, multipolar, and programmable era. The risk is not an apocalyptic scenario. It is miscalculation. If blocks misread each other's strength, volatility increases. If debt markets destabilize, liquidity tightens. Modern economies are highly dependent on asset prices, so such shocks can have widespread impact. The era of cheap money is over. The defining word of the new era will likely be sovereignty. And sovereignty is expensive. Higher costs, slower speed, more friction. This is not an ending, it is a transition. Globalization was not an ideology, it was a financial structure. That structure is now being redesigned, not through grand declarations, but through incremental steps. And not everyone will receive an equal share of this redistribution. The coming period will reveal where power ultimately concentrates. Watching capital flows, reserve allocations, and energy contracts will be enough. The new order will be built quietly. And by the time the world fully realizes it, the transformation will already be complete.